Financial risk is an inherent and unavoidable component of virtually every financial activity we undertake. This applies whether we are managing a personal budget or engaging in complex global investments. It represents the potential for an undesirable outcome, specifically a loss or the failure to achieve a desired financial goal. Understanding financial risk is not merely an academic exercise, it is crucial for making informed decisions in our daily lives. This knowledge empowers individuals and organizations to navigate the complexities of the financial world more effectively. Ultimately, a solid grasp of financial risk is essential for protecting one's financial well-being and securing future prosperity. At its core, financial risk primarily stems from uncertainty. The future is inherently unpredictable, and this unpredictability introduces various elements that can impact financial outcomes. These uncertainties manifest in several key sources that contribute to financial risk. One significant source is market fluctuations. The values of assets, commodities, and currencies are constantly changing, often in unpredictable ways. Economic downturns also pose a substantial risk, as periods of recession or slow growth can severely impact incomes and investment values. Unexpected expenses, such as medical emergencies or unforeseen repairs, can quickly deplete savings and create financial strain. Furthermore, poor personal choices, including excessive debt or inadequate planning, significantly contribute to individual financial risk. Collectively, these sources of uncertainty can lead to financial instability. They highlight the critical need for careful consideration and strategic planning in all financial endeavors. Financial risk is not a monolithic concept, it encompasses various types, each with its unique characteristics and potential impact. Recognizing these distinct categories is fundamental to developing comprehensive risk management strategies. Let us explore some of the most prevalent forms of financial risk. Market risk refers to the potential for losses due to broad changes in overall market conditions. These shifts are often beyond the control of individual investors or businesses. A common example is the fluctuation in stock prices, where the value of investments can rise or fall dramatically based on market sentiment and economic news. Interest rate fluctuations also represent a significant market risk, affecting borrowing costs and the value of fixed income investments. Similarly, currency exchange rate fluctuations can impact international trade and investments, leading to unexpected gains or losses. Understanding market dynamics is key to anticipating and responding to these pervasive risks. Credit risk is the possibility that a borrower will fail to meet their debt obligations. This includes failing to make scheduled interest payments or repaying the principal amount. For lenders, this directly translates into potential financial losses. Banks, for instance, face credit risk when they extend loans to individuals or businesses. The assessment of a borrower's creditworthiness is a critical step in mitigating this particular risk. Liquidity risk arises when an asset cannot be converted into cash quickly enough to meet financial obligations. This difficulty occurs without incurring a significant loss in its value. Holding illiquid assets can create problems if immediate funds are needed. For example, real estate is generally less liquid than publicly traded stocks. An inability to sell an asset quickly at a fair price can lead to financial distress. Operational risk encompasses losses that result from inadequate or failed internal processes, people, and systems. It also includes losses from external events. This broad category covers a wide range of potential issues. Examples include fraud, whether internal or external, and human errors in data entry or decision-making. Technological failures, such as system outages or cyber attacks, also fall under operational risk. Effective internal controls and robust systems are vital for managing this type of risk. Inflation risk is the danger that the purchasing power of money will erode over time due to rising prices. As inflation increases, each unit of currency buys fewer goods and services. This means that the real value of savings and investments decreases. This erosion of purchasing power makes it harder to maintain financial goals, especially for long-term objectives like retirement. Protecting against inflation requires strategic investment choices that aim to outpace the rate of price increases. Effectively managing financial risk involves a multifaceted and systematic strategy. It is not about avoiding all risk, which is often impossible, but rather about understanding, assessing, and mitigating it. This proactive approach helps to safeguard financial stability and promote growth. The first crucial step in risk management is thorough risk assessment. This involves identifying all potential risks that could impact financial objectives. Once identified, each risk must be evaluated based on its likelihood of occurring and its potential impact if it does. This evaluation allows for the prioritization of efforts, focusing resources on the most significant threats. A clear understanding of potential risks is the foundation for developing effective countermeasures. Once risks are assessed, various strategies can be employed to mitigate their potential negative effects. These strategies aim to reduce either the likelihood or the impact of identified risks. Diversification is a cornerstone of risk mitigation, particularly in investing. This involves spreading investments across different asset classes, industries, and geographical regions. The purpose is to reduce exposure to any single risk, so that a poor performance in one area does not devastate the entire portfolio. Hedging is another sophisticated strategy that uses financial instruments to offset potential losses from adverse price movements. For example, an investor might use options or futures contracts to protect against a decline in the value of a stock holding. Insurance is a widely used method for transferring risk. Individuals or businesses pay premiums to an insurance provider, who then assumes the financial burden of specific risks, such as property damage or health emergencies. This transfers the financial impact of a potentially large loss to a third party. A critical component of effective risk management is understanding one's own risk tolerance. This refers to an individual's or institution's capacity and willingness to accept financial risk. It is a deeply personal factor that influences investment and financial planning decisions. Those with a higher risk tolerance are often comfortable with investments that offer potentially higher returns but also carry greater potential for losses. Conversely, individuals with a lower risk tolerance prioritize capital preservation and stability. They typically opt for safer, lower return investments. Aligning financial decisions with one's true risk tolerance is essential for long-term financial comfort and success. Effective financial risk management is not about eliminating risk entirely, as risk is an inherent part of financial life. Instead, it is about intelligently navigating these uncertainties to achieve desired outcomes. This involves a continuous and dynamic process. The journey begins with diligently identifying potential risks that could derail financial plans. It then progresses to implementing appropriate mitigation strategies tailored to those specific risks. Crucially, it also requires a deep understanding of one's own risk tolerance, ensuring that financial decisions align with personal comfort levels. By embracing these principles, individuals and organizations can navigate financial complexities with greater confidence. This proactive approach significantly increases the likelihood of achieving financial goals more successfully. Financial risk management is an ongoing process, demanding continuous learning and adapting to changing market conditions. Seeking professional advice when needed can also provide invaluable support in this complex endeavor.